Hi, and welcome to economyxAI. In this video, we'll look at the commercial and residential real estate market in America, following the Fed's interest rate rises and COVID-19 work-from-home trends. Commercial and residential real estate is one of the most important sectors of the U.S. economy. It is responsible for employing 7% of the workforce. 16% of total GDP is related to housing and housing services. The real estate sector covers a number of related segments, including commercial real estate, residential real estate, and construction. Let's start with commercial real estate. The COVID-19 pandemic forced office workers to move from primarily working out of commercial office buildings to mainly working from their homes. As leases expired, companies drastically reduced the square footage they rented or failed to renew leases altogether. This tanked demand for commercial real estate. Residential real estate has also faced COVID-related ill effects. The inflation set off during the COVID period has forced the Fed to raise interest rates from almost zero in 2020 to over 5% now. This, in turn, has caused mortgage rates to steadily rise. Have the sky-high interest rates driven buyers out of the housing market and lowered home prices? Has working from home led to mass vacancy rates and falling prices for commercial real estate? Let's go to economyxAI and take a look at the evidence. On a regional basis, the biggest states for real estate are New York, California, Florida, Texas, and Illinois. In New York, sentiment in the overall real estate market has been flat to negative since July 2021. The latest numbers for September 2023 show overall neutral sentiment, with the office real estate market deteriorating slightly, with a modest decrease in occupancy rates and fall in commercial rents. The exceptionally low supply of residential properties has continued to restrain home sales across the district. This lack of homes for sale on the market has pushed up prices, further frustrating potential buyers. With so few properties to choose from, bidding wars have become an unpleasant feature of the home buying experience in upstate New York and in the suburbs around New York City. Homeowners who have locked in a low mortgage rate don't want to move because that would mean having to borrow at a much higher rate. The resulting lack of inventory leaves little choice for potential sellers, making low inventory self-reinforcing. In the 12th District, which covers California, Washington, Nevada, Arizona, and Utah, overall real estate sentiment hasn't been positive for a while. The latest September numbers show that the office real estate sector remained weaker because of higher than normal vacancy rates. There is evidence that the demand for single-family homes remained strong, but supplies of existing single-family homes that are for sale remained low. This is because owners are reluctant to move and give up lower-rate mortgages that many have locked in with 30-year mortgages. The Atlanta Fed covers Florida, and data from there shows that commercial real estate conditions have slowed. Transaction volume continued to fall because of challenges with getting financing for office space. Overall, the housing market throughout the Atlanta Fed district remained healthy despite higher mortgage rates. Although the pace of sales was below that of a year ago, home prices continued to rise. But as in the other districts, supply shortages in the resale market persisted. Once again, this was mainly due to homeowners with low-rate mortgages being reluctant to sell. In Texas, the Dallas Fed reported that the office real estate market continues to face sluggish rents and high vacancy rates. But there was a bright spot in the industrial real estate market, which remained solid. Housing demand for new homes also remained solid because builders were offering incentives such as rate buydowns that helped to lower mortgage rates. But existing home sales declined. This was primarily because of low inventories of homes available for sale. In Illinois, the Chicago Fed reported that commercial real estate prices fell slightly and rents were down modestly in some sectors, most notably for office space. Many investors were holding off on making commercial real estate purchases because they expected prices to fall further. Here as well, Residential real estate activity decreased slightly because there were few homes available for sale. Those that were for sale were selling quickly, and many of them received multiple offers. Banking contacts in the Chicago Fed region said that some borrowers who they had pre-qualified for mortgages were switching to new construction after getting frustrated in their search for an existing home. For the last 2 years, the Federal Reserve has been battling inflation. Its weapon of choice, or should we say no choice, is interest rates. During this period, mortgage rates soared, climbing from less than 3% in 2020 to more than 7% and heading towards 8% now. This is a 25-year high. An average family buying a house now will have to spend almost a third of their household income on mortgage payments. This has doubled from roughly 14% of monthly household income back in 2020. It is the highest that mortgages have been compared to incomes since 1985. But what exactly is this doing to the real estate market? Well, house prices have continued to rise. In the second quarter of the year, they rose at an annualized rate of 15%, according to the S&P Case-Shiller Index. Homebuilders are reporting that even with these high mortgage rates, there are still buyers out there. But since they have very few options in existing homes, are being forced to look at new construction. But the higher rates go, the more demand will fall. Eventually, this is going to catch up to the new home builders as well. Although demand for homes has fallen as rates have risen, the supply of properties available on the market has fallen even more. Homeowners who got low-interest mortgages before the Fed raised rates have no desire to give them up and so are unwilling to sell their homes. This means that there has been a decline in real estate transactions, but not a fall in home prices. People who decide to stay in their existing home often end up remodeling. Home remodeling expenditures in 2022 reached nearly $570 billion, or about 2% of GDP. This is a 40% jump from 2019, according to the Joint Center for Housing Studies at Harvard University. But what does this mean for inflation? A sustained rebound in home prices complicates the inflation picture. Property prices show up in inflation indices as rents rather than straight purchase prices. So it is not a linear relationship. But if the unaffordability of housing forces more would-be homebuyers into the rental market, it could push up rents and add to inflation. But for now, the real estate market seems to be treading water. But the question is, how sustainable is it for families to continue to pay a third or more of their household income on housing? How will it affect other parts of the economy if they have less to spend on other things? Let us know what you think in the comments below, and remember to like and subscribe.